Welcome back. Now what we are going to do is answer the basic question as to who really sets the price in the stock market. That is, we are going to address both the primary and the secondary market. Let's begin with the secondary market first. Now in case of the secondary market, the stock prices are a result of continuous buying and trading by all the various types of participants in the market. This includes the retail investors, institutional investors, short-term or long-term traders, and market makers. Since this group of participants covers people from all walks of life, including those individuals who are trading in the stock of a company they may be employed in, it would be fair to assume that some individuals who trade in the market might have access to insider information as well. This implies that every information available to anyone, that is both retail and institutional investors, is reflected in the market prices. Hence, it is said that the prices reflect the collective wisdom of all market participants, and the price of any security in the stock market is set by these participants. However, this discussion relates specifically to the secondary market. Now, pricing in the primary market, that is the IPO market, works a little differently. So now let's look at how pricing works in the IPO market. While the details on how IPOs are priced may vary from country to country, still we can broadly say that there are two ways in which an IPO may be priced. These are the fixed price issue and the Dutch auction, which is also known as the book-built issue. Let's look at them one by one, starting with the fixed price issue. In a fixed price issue, the company issuing the security consults with the lead manager and decides the issue price. The lead manager justifies the price based on expected performance of the company and also on the basis of price of shares of comparable companies in the market. Once the company makes this information public, the investor knows at what price the shares would be issued to them. All the relevant information, including financial performance of past few years, is made available so that the investors may decide if they should invest in the issue or not. Another way of pricing IPOs is by the way of a Dutch auction. Dutch auction or the book-built issue method determines the price market is willing to pay for the security being issued. The company and the issue manager may specify a floor price, which is the minimum bid price they are willing to accept. Alternatively, they may specify a price band, that is a minimum and maximum price within which the investor can bid. So when the issue opens, retail investors place a bid price and bid quantity. The bid price is required to be above the floor price or within the price band. Once all the bid has been received, the issuer of the security, in consultation with the lead manager, decides on the cutoff price of the security. All bidders who have bid above the cutoff price get an allotment of shares at the cutoff price. Let's look at an example of how this might work. For example, say a company wants to issue 1000 shares through a book-built offer within a price band of 120 to 144. Now bids are received like what is shown here in the table. Now the company would sort the bids received with the highest bid price at the top. So you see here how the highest bid price and the bid quantity is at the top and the lowest bid price bid quantity is at the bottom. Now the company would start by allocating shares to the highest bidder first and progressively moves down until all shares that need to be sold are allocated. So in this example, first the company allots 200 shares to the bidder with bid price of 144. Since the company intends to sell 1000 shares, it still has 800 shares left. Hence it will look at the next bid at 140 and it will allot the 300 shares. After both these allocations, still 500 shares are left. So now it will look at the next bid. Here again it will allot 500 shares. So now the company has allotted all the 1000 shares it wants to sell. Now since 135 is the lowest bid price at which shares were allotted, this becomes the cutoff price. all investors who bid at this price and higher are eligible for allotment. The company may also decide the cutoff price at a price lower than the price at which the issue is subscribed for the benefit of the investors. There could also be a clause for retail investors to be allotted shares at a discounted price.